Hi guys, Max here, and this is your daily market update for yesterday, the 20th of July. And it was actually quite a volatile day with investors really not sure how to price assets. Of course, we had that absolutely mega rally the day before with stocks rising by 3 or 4% on average. And equities were up again for the day, but it wasn't really as consistent and it certainly wasn't as strong. Tech companies did perform better than the rest of the markets on average, with some companies like Amazon and Meta really outperforming, Nvidia as well. The S&P 500 then rose by 0.6% and the Nasdaq rose by 1.6%, with the Dow Jones rising by just 0.2% by the end of the day. Across the rest of the world, it was a little bit less positive, with stocks falling on average. The FTSE 100 was down by 0.4% and the Stoxx 600 down by 0.2%. Asia was quite poor as well, and the Americas saw nothing to write home about. The MSCI World Index then rose by 0.5% for the day. Now, in the world of currencies, there really wasn't much of a change. The dollar did strengthen very, very slightly, but these figures you're going to have heard before. The euro is back down at $1.02 each. The pound is back at $1.20 each, and the yen is still sitting at 138 yen per dollar. So really no major changes there in foreign currencies. In the world of the bond markets, in fixed income assets, it was pretty much the same story again. Not much change for the most part. The US 10-year Treasury yield is still sitting at 3.03% for the day. The German yield fell by 2 basis points and the British fell by 4, so nothing major there. Now, in the world of commodities, actually, we did see quite a large drop in the price of oil. WTI crude oil at the time of me making this video is down about 6% from yesterday, sitting at $96 a barrel, with Brent crude a touch higher at $103. That's quite a major drop from the figures we were seeing a couple of days ago, where WTI crude oil was safely above $100, and it seemed like it might have started its rise again. Gold prices still sitting around that $1,710 an ounce, so no moves there either. In the world of crypto, it looks really bad from this heat map here, but we need to remember that this is after a day of rally the day before, and on the most part, coins were only down by 2 to 5%. Bitcoin is still sitting close to $23,000, so actually far stronger than it has been over recent weeks. Ethereum at $1,500, so again, far stronger than it has been in recent weeks, and most altcoins were down by somewhere around 5% for the day. Now, was there some bad news to cause this slight dip? Well, yes, there actually was, and it comes out of Tesla, who sold about 75% of their Bitcoin, and this is being perceived by some certain investors in the crypto market as a lack of faith in the ability of cryptocurrencies like Bitcoin to hold their value as we move on into a recession. Tesla's reasoning for selling this Bitcoin was that a recession is basically coming at this point, and they want as much cash on hand to deal with that recession as possible. That does seem very slightly like they don't trust the value of Bitcoin to maintain itself as they move on into these tougher economic environments. Now, speaking of Tesla, we of course got their earnings report, which was really quite interesting. The share price of Tesla shot up by 4% as this report came out, and then it dropped back down to where it was anyway. Now, this is obviously a huge topic, and I am going to put out a second video out later today to cover this in its entirety. But what were the most important bits from this that we'll just touch on today? Well, revenue from automotive sales actually fell slightly, which isn't the best news that Tesla have had, but this isn't really their fault. It's mostly due to the lockdowns in China halting their factory, meaning that they can't release and sell as many vehicles, and so the revenue fell for that reason. Tesla also actually had some bad news regarding its profitability. It would have been cash flow negative for the quarter, but as I said earlier, they sold 75% of their Bitcoin, and that gave them, give or take, another $900 million to put on their balance sheet, so that made them actually positive. But if it weren't for that sale, then they would have been cash flow negative. The margins that they see on their auto sales actually fell as well. Now, that isn't a great thing either, but again, there is a silver lining here. Coming from the company's CFO here, we can see that Austin and Berlin ramp inefficiencies will continue to weigh on our margins for the balance of the year. However, the impact should reduce as we ramp. Basically, because these factories are still new, they're not quite as efficient as they could be, and so that's causing this decline in automotive margins. But as these factories get up to speed, they do expect that to resolve itself and for margins to start rising again. So that does have some silver linings behind that news there. Now, the headline figures from this earnings report were actually really quite good, which is why the share price jumped by about 4.5% instantly. But then the details were just a little bit less good. Things like the fact that Tesla is cash flow positive, but only because they managed to sell sell off $900 million worth of their Bitcoin. So this wasn't a bad or an awful report by any means at all. It was, though, a weaker quarter than Tesla would have liked, and it just wasn't brilliant, which is really what you need to see from Tesla to justify their valuation. They are still priced for perfection. As I speak right now, they have a PE ratio of about 100, meaning that if they gave out every single profit, every dollar in profit that they had in dividends to their investors, well, it would still take 100 years to see a return on your investment. Unfortunately, I just don't think Tesla is executing to perfection, which is one of the reasons why I don't think it's a good investment at this price right now. Now, staying in line with electric vehicles and auto manufacturers, we have some news coming out of Ford that they are cutting 8,000 jobs in their internal combustion engine division. Now, they're claiming that this is so that they can switch on over to electric vehicle manufacturing, and that this has nothing to do with a coming recession or anything like that. Frankly, though, I don't think that's true. Ford still sell very few electric vehicles in the first place. They are a fraction of their total sales, and they're still loss-making on their electric vehicles too. So I do think this is a bit of a white lie. The reality is that a recession is coming. Ford's vehicles, actually all of the vehicles that they produce on average, their engined ones and their electric ones, they're all unprofitable right now. So changes need to be made, and things are only going to get worse as the monetary environment continues to tighten. We got a little bit of news out from some other manufacturers as well. Rivian, who exclusively make electric vehicles, well, they're cutting their jobs down by about 5%. All of their staff, they're going to cut 5% of all of their employees. Of course, they're a very similar company to Tesla, just far, far, far less successful, but they're going to be seeing the same sort of impacts to their demand and to their costs that Tesla are seeing. Coming out of Lyft then, they're seeing a lot of turmoil, and they are cutting 2% of their workforce this week, coming from the rental car unit of their business. Now again, this is just preparation for the recession that they're seeing. They are a deeply unprofitable company, and they need to change to survive. This is a very natural thing, as sad as it is that people are going to be losing their jobs. The big problem for a company like Lyft is that actually their business model, and the same with a company like Uber, it just doesn't work and it just isn't profitable. They've got this valuation based on the idea that at some point in the future they'll be able to make it work, but they've been around for about a decade at this point and it still isn't working. So I think they are going to seriously struggle in a recession. Now, we have some bad news coming out of Europe, and really there's just a whole load of chaos in Europe. Things really aren't looking too good for the EU and the continent in general. Now, straight out of Italy, their president has just resigned. He basically had no support from the government anymore, and this was seen a little bit in advance. And so there's going to be a new early election coming. Now, he was a formal central banker, but he hasn't done particularly well in running the country, at least in my opinion. Italian politics, though, is notoriously incredibly volatile. I believe the statistic I saw the other day was that over the last 70 years, Italy has had 50 separate governments, which is absolutely insane. Now, on this news that Mario is resigning, Italian stocks and bond prices dropped dramatically in value because change can be dangerous, it's uncertain, and investors like to know what to expect in the future so that they can plan around it. Italy is also facing a little bit of a European debt crisis Mark II, electric boogaloo, maybe even. Basically, Italian debt is too expensive. They can't afford it when it gets expensive, and so it needs to become cheaper. The problem is the European Central Bank can't fight expensive debt and fight inflation at the same time, and the EU is sort of torn in half behind North and South, countries which want different actions from central banks to support their own countries, and the euro, the shared currency, just can't cater to everyone, which is one of the reasons it really isn't a great idea, at least in my opinion. The EU and the ECB here are stuck between a rock and a hard place, and that isn't going to stop. Now, I mentioned very briefly there the divide between the southern EU and the northern EU, and that's getting worse too. Now, in particular, we're talking about natural gas and a little bit of a lover's spat between southern countries like Spain, Greece, and Portugal, and then northern countries like Germany and the Netherlands. Now, basically, Germany and the EU in particular, the central body, they want the south of the EU and the rest of the EU too to use about 15% less natural gas to try and bring demand for natural gas down and bring prices down either. The problem is the EU is this massive bureaucratic monster, and the legislation that they've put forward at first is just a non-committal idea to reduce gas usage by 15%. But if the EU declares an emergency regarding gas use, then they can make it mandatory and they can force these countries to do what they want. These countries obviously don't like that idea. Why would they? They are sovereign nations which have a supranational authority telling them what to do. So Spain, Greece and Portugal in particular have basically told the EU and Germany to piss off, that they aren't interested in this idea and they're not going to put it forward. The Spanish Minister for Energy literally said, contrary to other countries, Spain hasn't been living beyond its means in energy terms, obviously talking about Germany, about the way that it's built its entire economy around manufacturing, using cheap Russian gas to do that. Now this again is not really going to be resolved anytime soon. Natural gas is a massively polarizing topic in Europe, and for good reason, because there are a load of problems with it, but there are also a load of problems with not getting it from Russia and not using natural gas. So Europe is just in general in absolutely loads of trouble. Europe, of course, though, isn't the only area in the world that's struggling right now. China is seeing some chaos too. Now, we mentioned last week how there were some bank runs, some small local regional banks were starting to go bankrupt and people were losing their deposits. They have been running out of money and things have, of course, been getting worse. The most recent development with this is that the banks have just turned around and said, oh no, that money you gave us, that wasn't a deposit, that was an investment. You didn't have a bank account with us, you had an investment vehicle with us, which was categorically false. It is undeniably false, but they're claiming it anyway, and the Communist Party is supporting these banks, and so these people now have no legal right to take out their money again. Now, as you might expect, the people who this is affecting, the people on the ground, the innocent Chinese, they are unhappy about this, and so they've been protesting, and so now the Communist Party has sent in tanks to defend these banks. Now, that is absolutely crazy. It is weirdly reminiscent of the Tiananmen Square massacre that we saw, I think, about 40 years ago now, but it isn't exactly surprising because this is the Communist Party and this is what Communist parties do. Now, of course, this all stems from the property collapse that we saw and started to report on last year. Every video I've spoken about this, I've made the point that actually this is going to take years to play out. Property collapses always do. They are slow processes, but they will have wide-ranging, really, really strong consequences, and this is just one of them. I do have some footage to show you of these tanks, so you're not just taking me at my word that the CCP has sent these tanks to these banks, and I'll put them in at the end of the video for you all. Finally then, I thought we'd just speak just a very little bit about the US presidency, and we got this new poll which basically says that most people in America don't want either Biden or Trump to run for the next election. Now, personally, I don't think this is too surprising. I think if you are surprised by this, then you probably have your head in the sand a little bit because both figures are very controversial. Now, this is a finance channel, so why are we talking about this? Well, because this means we're actually likely to see two newcomers to the politics scene. Biden probably won't run at all because he's just a bit too old and incapable at this point, and Trump is getting old, but he's also probably just too controversial. Now, Trump in the past proved that an abnormal candidate who has anti-establishment rhetoric can win, and so what we could see here is a massive change with a massive wild card in the presidency come 2024, radical policies and big impacts on markets. Maybe the Democrats go forward with someone like Bernie Sanders. Maybe we get a really radical Republican nominee who goes on to win as well. Basically, what we don't have right now regarding the US presidency is certainty, and that will impact markets. Uncertainty, as I've said time and time again, is absolutely hated by investors, and they just don't like it. If you enjoyed this video, then make sure to like, comment and subscribe to bless the YouTube algorithm. It really does help. If you want to join our exclusive community, then check out our Patreon. You get access to our Discord server and extra content like access to my portfolio and buy and sell alerts for all my own investments. Also, make sure to check out the link in the description to Masterworks. It can help you protect your portfolio against market turmoil through fractional shares of art from world-famous artists. Art has historically proven to be uncorrelated to the markets, so it's a really valuable resource with the markets falling every week. There's also a link in the description to iTrust Capital, which helps you to invest in crypto through your tax-advantaged IRA, which could literally save you thousands. If you, like me, think crypto going down is a buy-in opportunity, then now is the perfect time to join iTrust Capital. Thank you all for watching. Stay stoic. Until next time.